Well, good afternoon, everyone, and welcome to our third series of the Superannuation Update, quarterly update. Now, once again, there has been a little bit that's been going on over the past 3 months since we last caught up, and it's also great to see so many people are interested in the topic today. So let's have a look at what's been going on within the wonderful world of superannuation over the last 3 months. Once again, just the general advice warning saying that while you can believe what I say, you can't actually believe it. So today we're going to look at, I suppose, a few things specifically that have gone on in the last 3 months. They are the Accountant Exemption Update, the SMSF Auditor Requirement Update. We'll have a look at the progress of the 2011-12 budget announcements. So this isn't the budget that was came down this year. It's actually the budget that came down last year, because our government have been making a couple of inroads into some of those promises. We'll touch on just a few ATO updates and some relevant bits and pieces through there. Briefly talk about the draft ruling in relation to when a pension starts and stops. The audit changes, so for any auditors that have commencing audits for self-managed super funds from 1 July, just a couple of things they just need to be aware of. And then, as usual, we'll touch on the compliance and cases that have been going on throughout the last 3 months. So, let's get started. Accountant exemption. Announcement on the 23rd of June 2012 that essentially they're introducing a new Australian Financial Services licence. Now, this is a new limited licence that will replace the current accountant's exemption. But this new licence won't actually start until 1 July 2016. There's actually going to be a 3-year transition period with this. So if you want to be quick off the mark, you can by all means start to apply for this new licence from 1 July 2013. But they're giving us 3 years, or I should say they're giving accountants 3 years to actually transition to that new arrangement. If you don't transition, then essentially you're caught under the existing arrangements, which is that you can advise clients to set up self-managed funds, but essentially that's about it. This new licence will allow you to advise on a class of product. So it'll allow you to talk about superannuation products, including self-managed super funds, pensions, the contributions, that sort of thing. But it won't let you talk about specific products. For example, an AMP public offer fund, or Sun Super, or Q Super. It will only let you talk about the class of product, being superannuation. It will also allow you to talk to clients about securities, so shares. Once again, it's about a class of product, not a particular product. So you could talk to a client about shares generally, but you couldn't say to them or give them the perceived advice that they should get, for argument's sake, BHP shares. Still unknown whether that class definition will extend to, say, instalment warrants or fully franked shares, a little bit more detail, like a subclass essentially. So a little bit more work has to be done on that. Managed funds. So as under the Corporations Act, a simple managed investment scheme, which is essentially anything that can be converted to cash within 10 days. A general life and life insurance, so you'll be able to talk to clients about those. And also basic deposits accounts, so bank accounts essentially. So it's a nice broad range of classes that you'll be able to talk to your clients about, and essentially offer them more than what you're probably doing at the moment. If you want to talk specifically to clients about product, then you will actually need to obtain a full-blown AFSL, for argument's sake, and become an authorised representative of that. Now, the requirements for this new licence is that it's available to professional accountants who hold a public practice certificate, and they'll basically will have to demonstrate relevant experience, and they will still need to meet training requirements to hold the license and to offer advice. So you can't have, it's not just a carte blanche, here is here's the license and away you go. You have to meet those CPD requirements, as we currently do now, to keep that license in play. You will also need to provide a statement of advice and also provide them a financial services guide. So essentially you'll be no different than any other financial advisor out in the marketplace. You'll need to give the client those bits of papers to essentially justify what you're telling them. Now, what makes this different, apart from I suppose the necessity, the ability to give them specific advice, the back end side of it is a lot less onerous than a current full-blown AFSL. There's no requirement to have an annual audit. So if you have an AFSL, you'll understand that you actually have to have a audit every year of the accounts, and you have to meet certain regulatory requirements. Those won't be actually part of this license. Essentially, the professional bodies will be taking up the slack there and building it in as part of their QA program. So next time, if you have one of these licenses, then your quality reviewer will need to look at all the advice you're giving and that sort of thing. Moving on to approved auditors. Once again, the same announcement on the 23rd of June. They've determined that, they've, I suppose, outlined the regime for SMSF auditors. So ASIC will administer the process. We already knew that. And the process will start for registration purposes from the 31st of January 2013. And auditors who want to conduct audits basically from 1 July 2013 must have the license. Must be approved to do the audit. Now, once again, professional bodies will play a part here. So to be an SMSF auditor, you will need to hold a public practice certificate and professional indemnity insurance, and have completed an approved SMSF audit course. So that's what the professional bodies require. The actual requirements of the legislation are that you have a tertiary accounting degree with an audit subject that was in that degree, and obviously you pass that audit subject. There is a fit and proper test that you must meet. The legislation will also require you to hold professional indemnity insurance, and you must have 300 hours of SMSF audit experience in the prior 3 years. There will also be a competency exam for new entrants into this new regime. And obviously accountants and auditors will need to comply with the APES, so that's the Australian Professional Ethics Standards for accountants, 110 being the Code of Ethics, and also the independence requirements come into it as well. Now, fortunately, for those auditors that are out in the marketplace now, they are having transitional arrangements. Now, I must admit, I think these transitional arrangements are quite lenient, which is surprising, I suppose, but nevertheless, that's what they've put in place, so I suppose all we can really do is make the most of it. So essentially, you have to satisfy the transitional requirements, you have to meet a prior experience test. Now, all that requires is that you conduct at least one audit in the prior 12 months prior to you actually registering to become an auditor. Now, if you do more than 20 audits during that prior 12 months, then you won't need to sit a competency exam either. So for argument's sake, if you did one audit or if you did 19 audits, you would need to sit a competency exam. If you did 20 or more, then you won't. So that's a good news for those auditors that are obviously doing more than 20 audits, because it's not having to go back to school, essentially. And the reason why they actually picked 20 was because that's essentially the average number of audits that accountants are doing. So there are a lot of firms, if you like, that are doing big numbers, but there are a lot more that are doing less than 5. So basically 20 is where the average sits. Costs to register for this program, obviously quite reasonable. $100 to actually register, $50 per annum to keep the license, and $100 for the exam. Now at this stage, if you obtain the license but you don't use it, then that's okay. But after a couple of years, ASIC might write to you and say, hey, you've got to basically show cause as to why you need it. So just something to bear in mind if your ears prick up and you're thinking, hey, great, I might start to get an audit license just for the sake of it, if you're so inclined. Now, as far as independence goes for self-managed super funds, I just thought I'd mention, while it's separate but obviously related, the Australian Professional Ethics Standard Board established a sub-working group to look at SMSF auditor independence. And basically they're developing guidelines that will relate specifically just to this. Now, according to the agenda for the next board meeting of APES, they're going to be discussing an update of that working group on the 14th of September. So in a couple of weeks, hopefully we'll have an update as to where they're thinking and where they're going. But essentially there are documentation in place or guidelines in place relating to independence and self-managed super funds. So I think they're just really looking to more codify that. Many years ago, probably back in about 2005, the tax office were making noises to actually try and entrench independence into legislation. I think through lobbying via the accounting bodies, that has abated a bit. So now basically the tax office and ASIC are more saying, look, we'll let the professional bodies worry about that whole independence thing. This is their business, so they can understand it and self-regulate better than what we can, essentially. So it'll be interesting to sort of see where that goes. Obviously, there's a lot of vested interests involved in that process too. Now, I mentioned about the budget, not the budget just gone, but the one before that. There's been some progress. So on the 27th of June, Tax and Superannuation Law Amendments, Measures Number 1, was introduced and has received royal assent. So when we spoke last time, it actually was in Parliament, but now it's actually received royal assent. So that means that the excessive contributions tax refund of up to $10,000 is now in place. As far as the legislation goes, the details on how that's actually going to work, however, is a little bit different. There's still a bit more water to pass under the bridge. For those of you who remember the surcharge days, when essentially the super fund would lodge the paper, or lodge the return, the tax office would say, hey, here's the payment that you need to make. That's the process that the tax office would like to see in relation to this excess contribution. So it will go basically to the fund, and then from there it will get reported around the traps a bit. Most of the industry pundits would prefer the excessive contributions tax regime, where essentially a notice gets sent to the member, and then the member verifies, and then from there the member has to fill out some paperwork and send it in. So I suppose it's more, it's less work for the super funds by doing that, but essentially for self-managed super it won't mean a great deal of difference in reality. So what that really means is that if a member has an excessive contribution of up to $10,000, they can have it released out of their superannuation fund. So essentially it's a legitimate form of early release, and they can receive that money and treat it as income in their own personal return. So then the tax office would say, right, here's your return, and now you owe us X amount of dollars. Now, I suppose you've probably heard it all verbatim, but just a couple of quick points on that. If you have the ability to use that excessive refund, but do you choose not to, then you will lose it. It's a use or lose, once a time only type thing. So basically, if you've got a client that even is excessive by $5, you might as well use it, because essentially you won't get another opportunity to. Pauses in the indexation of the contribution cap up until 2014. That was also in the same tax law amendment. The ATO to disclose individuals' super information to funds, and employers are to report onto pay slips for that actually go to their employees. Now, once again, legislation's passed, but the regulations aren't due until late this year. So that means that in the next basically 6 months, there's going to be a bit of work to do for all the payroll providers out there, because their systems are going to have to be changed to actually allow for that type of reporting. Bit of an update on the regulation, the Stronger Super announcements. Once again, these were also reaffirmed in the 2011-12 budget, and this is really where most of the movement, I suppose, in the sheep station has been. The SMSFs are to now value their assets at net market value. So that regulation has been passed. I'll touch on that in a tick. ATO Administrative penalties. We have draft legislation in play that this will commence from 1 July 2013. Once again, I'll talk about that. Banning of off-market transfers. This officially has been delayed until 1 July 2013. However, I've noticed that on the consultation program that the ATO have actually referred to an early 2013 release of an SMSF market value requirements for related party transfers. Now, the reason why the banning of off-market transfer legislation has essentially not eventuated is because of the Corporations Act, and by entrenching that into the SLIS legislation, it would actually be in contravention of the Corporations Act. So they've basically put it in a too hard basket. It's one of those grandiose ideas that politicians and public servants come up with, but then when it comes down to the detail, it's a little bit harder to actually do. So what they're looking to do, I would suggest, is actually codify it a little bit differently, and by actually putting a market valuation requirement, so almost like having a best practice paper in place. And this is likely to stipulate that a off-market transfer must be lodged within a certain period of time after essentially after the dating or the signing of the transfer document. So that way it would alleviate the issues, or the perceived issues, that people are backdating transfer documents 3-6 months to essentially cherry pick the timing of the market, or to circumnavigate contribution timing, that sort of thing. So that's a bit of a watch this space. So they say early 2013. Given the current progress of things, we might be lucky to see that by June. Not that I'm being sceptical at all. So now talking about the SIS regulations. So these are the amendments that came through, I think from memory it was about the 6th of August. So market valuations. All assets in a self-managed super fund must be at market value for the 2013 year onwards. Now, this essentially means that the amount that a buyer is willing to pay for an asset, and could reasonably be expected to pay to acquire that asset from a willing seller. Now, that's essentially, is the definition under the SIS Act, and there's also penalties that are imposed if you don't do that. And as you can see there, those penalties can be between 50 to 100 penalty points. Now, the way the SIS legislation works, if you're not aware, is that everything is basically based on penalty points. So the more points, the more you pay, because each penalty unit is $110. So the range between 50 to 100, basically 50 means that you haven't done it at market value and it was a mistake, essentially. 100 means that you've done it deliberately to avoid it for a particular reason. So perhaps you're commencing a pension and you didn't want the value to be too high to maximise the tax-free status of the pension. So then they can obviously hit you with more penalties. So I'll be going back to that penalty unit regime as we go through some other bits and pieces as well. So then the next day, or the same day, the tax office actually released ATO valuation guidelines. So that's the URL there that you can see, and oops, that didn't work. And then hopefully when you receive the slides, up in the top right-hand corner there, that's actually the valuation document itself. But if you go to the ATO's website, and you can find it there via the Superannuation tab. And the reason why I would recommend you doing that is that it's quite a detailed document, and it also goes into when specific types of valuations are required. So for argument's sake, if it's for the collectibles and personal use assets regime, then you need independent valuations. Most other things at this stage, so for properties, that sort of thing, basically just require the ability to be able to demonstrate that the valuation was used at a fair and reasonable process. Now, as I mentioned, the valuation requirements stipulate that it has to be done each year. So this obviously gets a little bit concerning when you're dealing with things like property, because it doesn't mean that you need to go to your friendly real estate agent, tap them on the shoulder and say, hey, can we have a market appraisal again? They're going to get a bit jack of that, and they'll cotton on pretty quickly that this is all a bit of a game. However, with property, consideration must be given each year to the value, but that doesn't mean that it actually has to be updated. But however, it must be updated if a significant event has occurred that may have changed its value since when it was last valued. So for argument's sake, there might have been a flood, there might have been some bushfires in the area, that sort of thing. That all needs to be taken into account. The property market might go through the roof, we can only hope. Then that would be a significant event because the valuation has changed significantly enough that another valuation is required. So if you administer self-managed super funds, I would strongly recommend that you have a look at that those guidelines, just to make sure that what you're telling the client is the right thing. Also in the same regulation amendment, investment strategies. And a self-managed super fund investment strategy now must consider insurance for one or more of the members of the fund. So that is regardless of the fact that the fund may have, say, 2 pensioners that are 95, the strategy still must consider insurance. And the reason for this is on the basis that that Australians are generally underinsured. They suggest that about 16% of people have life insurance inside their super fund. However, of self-managed funds, close to 50% have started some form of pension. So the reality is they've probably targeted this particular regime for about 35% of the members of self-managed super funds. But unfortunately, everyone has to comply. If you don't, it's now an operating standard, so that means the tax office can come in and hit you up with a 50 penalty units for not having it incorporated into the strategy. Now, what's interesting is there's still nothing to actually say that the strategy has to be in writing. However, for an auditor to consider the strategy, and obviously for the strategy to at least consider insurance, it would make sense that it is in writing. So I think it would be very hard for a trustee to basically stand in front of the tax office or in front of the judge and say, Your Honour, I had considered the risk and diversity of my investments as well as the insurance, and I think I'm fine. If it's on paper, it's black and white. Now, the other thing is that investment strategies now must be regularly reviewed. Now, obviously that's very ambiguous as far as what regularly means. So regularly could be once a year, or it could be once a month. Ultimately, that's going to be a decision that as administrators of super funds you might want to consider. But I suppose a decent minute can work around the official reviewing of a strategy every 12 months, and obviously you can refer to the fact that it's been regularly reviewed throughout the year. So that's the way to sort of, I suppose, bypass any issues of having to physically undertake a review of the investment strategy every month or quarter. Obviously, if they've got a financial advisor, then that could be a function that they actually undertake, that advisor undertakes. And finally, in this regulation that came out, is a separation of assets. Now, you may be aware that under Section 52(2)(d) of the SIS Act, it actually requires assets to be held separately. However, it was never an operating standard before, so the tax office couldn't really do much about it, because really in their kit bag, they only have a slap on the wrist, which is a letter, or non-compliance. They don't have a lot in between. By making it an operating standard, it actually gives them a little bit more power to actually do something about it. So once again, if they don't keep assets separate, 50 penalty units will be coming their way. So that's $5,500. So it's a decent incentive for clients doing the right thing. Now, recently, the ATO released a consultation paper via I suppose they released draft legislation that's really in consultation phase at the moment, I think until the 14th of September, that has put, I suppose, what's been termed speeding fines for self-managed super fund trustees who don't quite do the right thing. So this bill basically gives the regulator the power to issue either a rectification direction and or an education direction where it believes the trustees require it. So they can actually make the trustees do a class to learn more about what they should be doing in running their self-managed super fund. And the trustees have to pay for that out of their own personal expense. The fund can't pay for that. Now, as I sort of mentioned before, the song and dance that occurs if the tax office come to help and look at your super fund is if they find an issue and they want to make the fund non-complying, to avoid that situation, you have to enter into what's referred to as an enforceable undertaking with the tax office. They can't draft that. The trustee has to draft that and present it to the tax office. Under this new regime that's being touted, basically the ATO will be able to issue a rectification direction to the trustees to say, hey, this is what you need to do to fix it, so fix it. Obviously, subject to the comments and the consultation process, it is proposed that this will come into effect from 1 July 2013. Now, it'll be very interesting to see how the tax office go policing this. And by that I mean that typically they've used auditors of self-managed super funds quite heavily to pick up people who aren't doing the right thing. Now, they still may do that. They may increase their audit program a bit more to actually do more random audits. But this has the potential to actually add a little bit of money into the government coffers, because at the moment, as I sort of mentioned, if you go through the song and dance and you enter into an enforceable undertaking, there's no financial penalty, obviously, except for whatever the transaction is you need to do to fix the problem. Whereas under this regime, there will now be financial penalties. So it will mean that trustees may have to come up with some money out of their own back pocket for not doing the right thing. So this is really a point that needs to be educated to clients once, I suppose, we have a bit more clearer idea of what's involved in the legislation, because it potentially will have implications for nearly everyone. So what they're looking at is basically 5 penalty units for a certain number of sections. So if the investment manager wasn't appointed in writing, then that's 5 penalty units. So $550. If you don't give information to the tax office when they ask for it, once again, $550. Or, and I thought this was interesting, if you don't complete a survey. So from time to time, the tax office will ask trustees to do questionnaires or undertake surveys. Now, they will actually be putting in, or they're actually making that now a penalty if they don't do that. 20 penalty units for if you make a written notice that isn't a written notice must be lodged to give and given to the tax office if the fund is no longer an SMSF. So say that you wind the fund up, or that it converts to a SAF. If you don't write to the tax office and tell them, then they will hit you up with 20 penalty units for that. 10 penalty units if the accounts, if they're not prepared. So you can see straight away what they're going to do. That basically, if the accounts are not prepared on time or to the tax office's timely satisfaction, then they will hit up trustees $5,500. Stuart Forsyth, who's the Assistant Commissioner for Superannuation, he doesn't like the fact, and fair enough too, that trustees are not lodging not enough trustees are lodging on time their self-managed super funds. So this is a financial incentive, for using that word, to make sure that trustees actually lodge on time. Also, they must keep minutes for 10 years. The difference between 1 and 2 there is 301 subsection 1 and 303 subsection 1 and 303 subsection 2. The difference between those is individual trustees and corporate trustees. So that's why there's some duplication there, just so you know. So basically, if you don't keep minutes for 10 years, then the tax office can hit you up with a fine or a penalty. Now, whenever you move from one accountant to the next, depending on that previous accountant's regime, if they didn't keep minutes, the chances are the client hasn't kept minutes, so they may be in breach. So I suppose as accountants, this is an area that perhaps we need to pay a bit more focus to, because although the obligation is on the trustees, you always want to be doing the right thing by your client. And obviously when you're preparing minutes or putting them on your file, then you might not understand or you might not know the client's going to stay or leave or whatever it might be. For unit trusts, Section 71E election They had to be kept in place for 10 years. That's a bit of a moot point, but they've still got it in there. And reports have to be kept for 10 years also. And finally, on the ATO Administrative penalties, 60 penalty units if a fund lends to a member or a relative of the super fund, so essentially financial assistance. If the fund borrows money that not within inside the limited recourse exemption, but just borrows money otherwise, they can be hit with the 60 units. In-house asset provisions haven't been complied with, or if there's a significant event that the regulator hasn't been told about immediately, then they can also hit them up with the penalties as well. Now, sorry, I've just got a couple of questions that have come in about the investment strategy. So basically the question is, if you don't have insurance with inside the super fund, surely you wouldn't need to consider it in the investment strategy. Well, unfortunately you do, because the strategy actually needs to make reference that you've considered it. The fact that you haven't taken it up is fine. So basically the strategy would need to say be along the lines of that the trustees have considered investment insurance policies for the members, and if they don't have it, then you might say that and have considered it not appropriate to, and the members have decided it's not appropriate in their circumstances to take up the policy on offer, or something along those sort of lines. And similarly, if you actually have insurance in your fund, the investment strategy still needs to make reference to it, even though you have it. So it might be that the trustees have offered insurance, and the members have decided to take up the insurance. You might want to, if you decide not to take it up, you might want to specify why they haven't taken it up. So it's the member has sufficient resources outside that they've decided that they don't need the insurance, that sort of thing. So you can't really have a carte blanche cover-all. It needs to be a little bit more, I suppose, customised for each individual client. So we'll be undertaking a process of asking our clients if they want us to help them with their investment strategy, updating the wording of that. And if they don't, that's fine, but I want to make sure they understand the penalties involved if they don't do it. So as a safe cover-all, then I think that's just the way you do it. Just quickly, early release schemes. There's draft legislation in play that imposes civil and criminal penalties for the promotion of early release schemes involving unlawful payments for regulated super funds. So just something just to bear in mind. Just a bit of a refresher, TPD deduction. In July 2012, TR 2012-6 was issued, and basically that there has changed the deductibility of TPD insurance from 1 July 2011. So the accounts you're doing right now this will apply to. So that's why I thought I'd just mention it. So if you have a TPD policy that has any occupation, that they are eligible to 100% tax deduction. If the occupation or training, skill and calling, then you're only entitled to a 67% deduction. If the TPD is bundled with life insurance and it's an own occupation, then the TPD your tax returns and financials, you just need to bear those in mind. So if you don't know the type of TPD cover you have inside the fund, then you'll need to ask the necessary questions. Obtain an authority from the client to go straight to the straight to the underwriter, the insurance company. Another alternative, if you don't want to do those, is you can actually get an actuary to calculate it. Given the fact that in most circumstances the TPD cover wouldn't, or the deduction that you couldn't claim wouldn't be ranging into the thousands. It's potentially even into the $500 or $600. It's probably not worthwhile going down that path. Another little tidbit just to be aware of, there's been an amendment to the tax ruling 2010-1 that basically says that now a notice of intent to claim a tax deduction can be provided to a fund other than the fund that actually received the contribution. So let's say, for argument's sake, a member made a contribution into Q Super, and then they rolled their balance into a self-managed fund. So long as they roll the entire balance to the self-managed fund and they haven't previously lodged a notice of intent to claim, then they can present to the self-managed fund a notice of intent to claim a tax deduction and then get the tax deduction inside their super fund. Previously, it actually had to be to the fund that received the contribution. So that's a slight difference than what we've had previously. So once again, just something to be aware of. Rollovers. From 1 July 2013, rollovers to self-managed super funds will be captured as a designated service under the anti-money laundering and counter-terrorism arrangements. So this means that the super funds transferring the benefits, so typically the APRA regulated funds, they will need to make sure that they have enough ID verification around that person moving the money from the APRA fund to the self-managed fund. So at the moment, the standard rollover form just requires a driver's license. Going forward, that's likely to be more than that. So it might also be a rates notice, Medicare card, something like that as well. So that's just something to be aware of. Now, you might remember the draft tax ruling of when a pension starts and stops. It created a bit of a furor for some, and obviously it continues to do so. Because initially, the last time we spoke, the tax office were essentially putting it off every couple of weeks as to when they would be releasing it. To the point where Stuart Forsyth even said, I can guarantee it'll be released soon. Well, unfortunately, that isn't the case, and I suggest it's been out of his hands. And at the moment, there's no indication of when the ATO are going to finalise that ruling. And the scuttlebutt throughout the industry is that it's the large industry APRA regulated funds that have just realised that this is actually going to cause them some grief. So they're having to basically, well, the rumour is that they've delayed it or put pressure on the government on the tax office to delay the finalisation of that ruling. So obviously, it makes it more advantageous for themselves. 2012 audit report changes. Just to be aware that there's been some changes to the audit report for those auditors. That basically they now have to expressly consider if the fund has complied with the section 67A and 67B requirements. So that's the limited recourse borrowing arrangements, and also the regulation 1318 AA requirements around the collectibles and personal use assets. So essentially, where they're stored and all those all those implications on that. So auditors now have to consider that as part of their audit. If you've been doing audits, and no doubt you would have downloaded the new audit report from the tax office's website, and you probably would have seen it there anyway. But just so you're aware. And now finally, we'll talk about a couple of, I think I've got 4 cases that sort of been derived or been handed down over the past few months, and there's some interesting decisions that have come out of it that I suppose you could call contradictory or surprising, to say the least. So the first one is this one, Parsby and Parks Proprietary Limited Super Benefits Fund. Now, in this case, a super fund loaned money to a related entity. Now, the tax office didn't really like that because there was no loan agreements and all that sort of stuff, and obviously you can't loan to a related entity anyway. So the tax office wanted an enforceable undertaking, which the trustees gave them, and that undertaking was to basically repay the loans. But surprise, surprise, they didn't do it. Now, there's nothing more the tax office hate than you telling them you're going to do something and you don't do it. So they made the fund non-complying. The trustees went to the AAT and said, hey, we think this isn't right, it's not fair. And what I think is very surprising is the AAT actually overturned the ATO's non-compliance status, because basically there was two criteria, if you like, that they considered as part of their judgment, and that imposing the non-compliance would leave them very little in the fund, which typically that hasn't been a consideration before. And the breaches, while they were serious, they were not willful. So basically the AAT have let them off for breaching the SIS Act, even though essentially they knew about it because they entered into enforceable undertakings, but on the basis that they didn't really understand what they were doing. So I found that quite surprising. And there aren't too many cases where the tax office lose at the AAT, and this one would have been a surprise to them. In fact, the tax office have released a decision impact statement on this case as well, which essentially talks about their practice statement 2006 something that refers to the process they go through when they make a fund non-complying. MH Gale Super Fund. This super fund sold farmland to related trusts, but under a deferred settlement arrangement. So, from memory, I think the contract was entered into in 2007. Excuse me, entered into in 2007, but settlement wasn't to occur until 2011. Now, because of the nature of the contract, the wording of the contract, the tax office determined that the parties were not dealing with each other on an arm's length basis. And as such, the income derived by the super fund from that unit trust, because it was a fixed entitlement trust, so that was fine. But because of that agreement or that arrangement wasn't what you would normally expect of an arm's length arrangement, the income from that trust was deemed to be special income, or now what's called to as non-arm's length income. So this was argued under the old rules, not the new ones. The trustees took it to the AAT, but the AAT affirmed the ATO's decision and said that yes, it was actually special income. So it was taxed at top marginal tax rate. A couple of cases that refer to or relate to excessive contributions now. So in the case of Brazil versus the tax office, the man actually withdrew $18,000 from an AON master trust and deposited it into what he called the Western Eagle Superannuation Fund. However, the Western Eagle Superannuation Fund didn't actually exist. There was no trust deed, there was no tax file number, no ABN, any of that sort of thing. So essentially, the tax office said, well, look, it didn't actually roll from one complying super fund to another, so therefore it's not a rollover. And the court held that that was correct, that it wasn't a rollover, and that it should be treated as assessable income in his personal tax return. So that $18,000 is now assessable in his personal return. In Borstein's case, Now this one's actually quite interesting because apparently he defended him, or he represented him himself, and this is one of the very, very, very few cases where the AAT have found in favour of the taxpayer and have treated as special circumstances for the reallocation of contributions. So in this case, as I said, the AAT set aside the ATO's decision that the contribution made to his super fund on the 10th of July 2007 should be attributed to the 2007 year. So the ATO said, no, I'm sorry, that's a 2008 contribution. Now, the AAT found the taxpayer had missed the deadline as a result of misunderstanding of the rules. Apparently he had printouts from the tax office website verifying the information that he was getting from the tax office website, as well as information that he'd been given from other parties, accountants, that sort of thing. So basically the AAT said, well, look, therefore it is special circumstances and we will reallocate it back to the 2007 year as you had actually originally intended. Another one, long cake. Now compare the pair, or compare the two, and you might be a bit surprised. AAT held that special circumstances existed which warranted the reallocation of the contributions received in July 2009 to the 2009 financial year. So the employee and employer, in this case the employee and employer, had an explicit agreement that salary sacrifice payments would be made for the 2009 financial year. However, because the taxpayer had changed super funds in which the money was paid into, an excessive contribution had arisen. So basically the AAT in this one said, yep, look, that's special circumstance, that's fine. We'll put that, we'll reallocate that back. So 2 wins for taxpayer. In one that wasn't so fortuitous, and if you compare this to Bornstein's case, the first one, basically AAT had decided that the concessional contributions made to a clearing account were attributed to the financial year in which they were allocated. So in this case, the employer made a contribution to the clearing account on the 29th of June 2007. Now the 30th of June was a Saturday or on a weekend anyway. So the clearinghouse didn't actually allocate those contributions to the super fund until the 2nd of July, being the next business day. Now the AAT said, look, I'm sorry, that's not actually special circumstances because it should have been reasonably foreseeable that that was to occur. So basically the tax office won that one and they didn't have to reallocate. Chantel, once again, AAT decided that the concessional contributions made electronically on the weekend of the 30th of June, credit to the member's account on the 2nd of July were not special circumstances to set aside the contributions or to reallocate the contributions into a different year. Now, what will be interesting to note is that I wonder if in, say, 4 or 5 years' time, we'll be looking back on excessive contributions cases for 2012, because obviously we've just had a similar situation where 30 June fell over the weekend, and I know I've already got one client that has had issues around this because he presumed that the bank's deposits would clear over the weekend when they didn't. So it could very well be that we'll have a similar round of situations in, say, 5 years' time. And essentially, that is it in a nutshell, the quarterly update on superannuation. So unless there are any more questions, I think I've answered that one there about the investment strategy. So unless there's any other questions, I think we might wrap it up there. So, well, thank you all very much for listening. And on the presumption that we actually get a quiet quarter of superannuation updates, if you have anything that you'd like me to actually sort of explore that I can do sort of in half an hour, by all means, drop me through an email. Via D is fine, and we can have a look at doing like a little bit of a special topic. At this rate, if the government and tax office keep their production going, we might not get a chance to actually look at those, but you just never know your luck. So if there's no other questions, then I think we'll leave it there. So thank you all very much for listening, and hopefully we'll speak next time. Thank you.